Welcome to Investing Confidential. I've been asked why I wear sunglasses once in a while, and the answer basically is because I feel like it. Oil markets today are off, pretty significant because obviously oil is a component of inflation, so we know that there's going to be continuing decline, slight declines in inflation. But I wouldn't like I said before, I think inflation is sticky, and also I wouldn't go short oil market or any of this news. There's a lot of geopolitical events out there that are actually bullish for oil, but certainly the news that OPEC is going to increase the amount of oil they flow out. Only about 500,000 barrels, by the way, which is really a small amount, but that's contributing to this weakness. We've got the EU sanctions coming on Russia, essentially basically cutting off Russia for good. To me, that's bullish. I don't know why that would be bearish, but that to me is bullish. Russia is just going to get more powerful because I don't think oil is going to go down after you cut off one of the top producers. But again, talking about top producers and why I don't think oil's a short and why I think oil actually is a long, okay, on weakness, is you've got this unrest in Iran. Okay, it's not getting much press, but certainly it's something to look at. For example, today, I don't know if you guys watched the first World Cup game, England versus Iran. There were, during the Iranian national anthem, there were boos from the Iranian crowd, believe it or not. So this leads me to believe that these protests and this unrest is going to continue. Iran is the seventh largest producer of oil. There's also fighting in the north of Iran with the Kurds, the Iranian Kurds. So, and a lot of the oil production is in the north. So if the seventh largest producer has problems producing, doesn't matter what kind of uptick in production that Saudi decides to do, and they're only doing a token amount. Then you've got the EU cutting off Russia. I mean, the prices shouldn't be down, folks. Prices should not be down. Anyway, let me address Bitcoin. As I said before, look, I don't look like a Bitcoin trader, obviously, and I'm not a Bitcoin expert. I do understand, well, I mean Bitcoin, I mean cryptocurrencies. I do understand Bitcoin extremely well. I was around when Mt. Gox went under. A lot of you guys don't even know what that is, but if you does watch my video from about a week and a half ago on Mt. Gox, it makes FTX look like a sideshow, because at the time it was the most dominant, the only dominant trader out there. Anyway, going beyond that, so you've got the Senate saying they're going to have hearings on FTX in December. I mean, look, this is toothless, but it's just going to contribute to negative sentiment. So I don't know how Bitcoin or any cryptocurrency is going to go higher into a Senate inquiry, right? So if this happens in early December, it's not good for sentiment. And all of this news coming out is causing traders to flee Bitcoin, right? So you see this now. Traders are getting out, okay? And positioning is bad. Look at the positioning on the Chicago Mercantile Exchange where Bitcoin futures trade. I mean, there's no one in there. They're out. That's obviously a very negative, but it also could be seen as a positive, meaning no one's involved. But we haven't seen the Bitcoin flush yet, and you got rumors on Grayscale today. I mean, if Grayscale is done, I think Bitcoin is going to test a psychological level of 10,000, and if it does test the level and break it, it's going to be a waterfall effect. Psychologically, you're looking at, who knows, 7,000 to 8,000 in support level, but you just don't know. And you've got, I mean, it's just bad. Look at Coinbase, for example. I mean, these are the bonds of Coinbase. The bond market is usually smarter than the stock market in terms of indicators. So, Coinbase bonds trading at or below 50 cents in the dollar. That's distress. That's default. That's massive distress. So that's not good for sentiment and the survival of these exchanges and these entities. So Grayscale, Coinbase, I have no idea. Now there's a rumor that Binance is going to have problems as well in terms of redemptions, and this is the problem with 2000. If you looked at what happened in 2008 with the with the financial crisis, what really accelerated this crisis was the run of the banks, right? People taking their money out, more institutions taking their money out of the large banks that they had prime brokerage relationships with. If you don't know that term, look it up. Prime brokerage relationships, custody. Once that money started to flow out, it was over. Okay, the crisis is over, and if the U.S. government did stand in, a lot of banks would have collapsed, which would probably have been a good thing. But anyway, let's not get into that. So we've got all these issues. The sentiment's not good. Bitcoin should probably trade lower. If it breaks this 10,000 mark, it's going to waterfall lower. And at that point, it's probably an interesting time to get in. Because as I've mentioned before, the problem with Bitcoin is not Bitcoin itself, it's all the other worthless cryptos. And I explained that in another video. Bitcoin, and I'll just brief on it. Bitcoin was created as an alternative to fiat currencies. So when Bitcoin got bastardized, meaning all of these coins started being developed out of thin air, what happened was Bitcoin became a fiat currency. People kept printing more coins. Every time you issue a new coin, you're basically diluting Bitcoin. And the premise of Bitcoin was actually really good, and so is the structure. So as all these other cryptos go to zero, Bitcoin, maybe that's one of the reasons it's held up. But Bitcoin should go higher, should be stable, and this is what you want, a stable Bitcoin. I'm not going to go into more, but that's basically it. That's my 2 cents on Bitcoin and the cryptos. Bad sentiment going forward. No reason to buy anything. Should you take your money out? I would not have $1 in any of these exchanges right now. Not one single dollar, because you may have, Bitcoin itself, but you have a run on these things. Just like in 2008, these institutions are gone. And at this time, the U.S. government and no one could bail them out. So that's the bottom line there. So I think there's another interesting thing that's going on today with the U.S. dollar. And again, as we talked about, the U.S. dollar is the key to everything, right? So goes the dollar, so goes financial assets, including stocks, bonds, etc. The interesting part of this is there's some real pessimism on the dollar. Okay, despite rates continuing to be higher, and I think through the end of this year, through the end of December, with the Fed coming out most likely with another 50 basis point rise, the dollar is going to remain firm. But there is positioning. There's smart money in quotation marks looking for that are very concerned about the dollar, and so that's something to watch out, because I think, as I said, I think inflation has come down. I think the real risk, financial risk in this environment is not, let's say, inflation, but stagflation and a continuing weakness in the U.S. dollar, which is going to hurt the U.S. government, rollover debt, etc. I mean, there's a lot of things into it, and I've touched on almost every video, and I'll continue to do that. But this is a real problem and something that everyone should be aware of, and something that is a lot more significant in terms of market implications than inflation, believe it or not. But let me tell you why. So why the dollar is the key to everything, and why you're probably going to see dollar weakness next year is the economy. Okay, like I said, the economy is stupid. The economy is very weak. It's going to continue to be weak. We're going to get we're going to get another recession indicator, meaning we might have 3 or 4 consecutive quarters of declining GDP in 2023, and that's not good for the dollar. Again, you've got inflation is declining, but not declining that much. Again, it's sticky, okay? But again, inflation is declining is also dollar negative. Then you got the big thing, which is the Fed balance sheet. It is still ridiculously too high. The Fed was supposed to reduce their balance sheet for fiscal reasons. They haven't done it, especially with mortgages. If they were to do that, mortgage rates would probably go to significantly higher, and the real estate market would continue to even go down even worse. But that has to happen. The Fed basically caused this whole problem. And they continue to cause a problem by not reducing the balance sheet. And it's a big risk for the United States. As rates around the world go higher and stay higher, they're not going to come down dramatically. It will come off, but not down dramatically. And if the Fed pivots, it's not going to reduce rates. It's going to keep rates high. Basically, if you look at the Fed balance sheet and how much we pay in interest every year, we're paying almost $400 billion in interest. Theoretically, that could double by next year with all of the rollovers, meaning we amortize our debt in a very short basis as we go. Rates are more than double. Our interest cost is going to go up, and that's also very dollar negative. So this is something to watch. And the other big thing is, from a trading perspective, treasuries, the most liquid instrument in the world for forever, it's been the most liquid, is now illiquid. Okay, I've been talking about liquidity from day one. The markets are illiquid. Absolutely, especially during the trading day, absolutely illiquid. So the fact that the treasuries are liquid is very strange, and also something that means we could have massive volatility going forward. So this is really an issue here. Let me address something that's kind of funny. So in the Wall Street Journal, you got this headline: "The U.S. market is the only game in town." That's their theory, or this author's theory, of why it's held up. And I just don't buy this. I mean, the U.S. market is not the only game in town. It sounds like this, Tina again. There is no alternative. I mean, no, the U.S. market is not the only game in town. International markets are much cheaper. Okay, look at the U.S. versus international markets in terms of valuations. The U.S. is still very expensive. Okay, so and if we have dollar weakness coupled with all these things I spoke about, international stocks are going to be the way to go. International markets, especially developing countries, and with with all of these ETFs and ADRs out there, which we spoke about in the past. Look at some of our past videos. It's accessible. I mean, look at this, for example. Look at something very interesting. In emerging markets, they've been refinancing. They've been extending their maturities for the last year and a half. Okay, U.S. has not extended. The maturities have gone down in the U.S. So the U.S. is much more vulnerable to high interest rates as emerging markets, and so there's no debt issues down the road. So that's one alternative to take a look at. But again, we'll go into that at another time. So the U.S. economy, at the end of the day, is extremely weak. I keep saying that, but I keep showing you things. Okay, look here first. Look at demand for chips. This is a leading indicator. Okay, there's too much supply, not enough demand. That means computers, cars, et cetera, and that's indicated that not only just the U.S. economy, but the world economy is very weak. Again, we've talked about the layoffs. The layoffs in the U.S. are just beginning. This is the beginning. Okay, this unemployment rate is going to skyrocket. It's on a hockey stick higher, and layoffs again are and that's not a reason to buy the market like some people think. Layoffs are not a reason to buy stocks. This is really bad. Okay, it's showing that there's just no demand. And then here we got Shanghai rate. This is incoming cargo from China. This activity is just dropped off the cliff. Okay, it's gone. I mean, it's unbelievable. The reversal since COVID began, and I don't see this changing anytime soon. Again, showing that there's no demand for goods and services. And then we've got real estate. We continue to talk about real estate, but the numbers keep coming in. Okay, the real estate continues to deteriorate fast. But again, if you watch CNBC or these other morons, they're gonna tell you that prices are holding up. I mean, they tell you that real estate is big, but this is all fake info. It's all false info. Okay, their advertisers must be telling them to put this kind of stuff up. You're just trying to confuse the consumer here. Prices on real estate are not up. Okay, no chance are they up. Look here, real estate supply. This is from Redfin. It's growing very fast, and I think in 6 months it's going to be way past the last 10 years in terms of supply. That's not going to be good for prices. Okay, not going to be good for prices. Here's two indicators. Whether you want to look at home resales, consecutive months declining back to the 70s, or U.S. existing home sales, either one of these indicators. Okay, look again. I'll repeat it again. Home resales, consecutive months declining back to the 1970s. It's unbelievable. And here is U.S. existing home sales falling off a cliff. No matter what indicator, no matter the chart, no matter what data you want to use, this is extremely bad. Extremely bad for the real estate market, but indicator that the economy is gone. Okay, it's fallen off a cliff, and don't believe anyone else telling you otherwise. I'll mention here China. They've got their own problems with housing. Again, here's a chart. This chart has been going on for quite a while, but I think it's going to deteriorate even further. Housing supply over demand, too much supply, not enough demand. When we show this chart again, it's going to be through the roof, okay? Significantly higher than what it is today. There's just no demand for real estate in China. China's got major problems. And again, let's talk about this because, again, we've got news here about Chinese stocks. Well, again, stocks are something that is a leading indicator or a current indicator. Stocks have reversed because of all this COVID news. Now, again, going back a week and a half, I spoke about this. There was a big move in Chinese stocks about COVID, the zero COVID's going away. As I said, this is nonsense. Fade this rally, and those who did made money. Okay, look at this. China had one COVID death. In this country, we had supposedly 1 million COVID deaths, okay? We don't know the true data, but let's assume it's right. They got one COVID death, and they've just shut down the capital of Beijing. Okay, the capital of Beijing, 20 plus million people are under lockdown or close to being locked down, and they have to get tested every single day through the app. Chinese COVID cases, as you can see here, are rising fast. So what does this tell you? I don't know what the Chinese government will do, the CCP, but the zero COVID policy is not going away anytime soon. And it continues to affect the Chinese economy. Again, this is what it all comes down to, the economy, stupid. And a weak Chinese economy is going to affect all these companies we have in the US, Apple being number one on the list. Okay, but you've got every car company, you got any manufacturing company, General Electric, et cetera, they're all affected. They all either they sell into China, they manufacture in China, they assemble in China. This is bad, and it's gonna hit the earnings really bad, and the market just hasn't even considered this yet. But then again, as we talked about this is all bad. But the market hasn't cracked, okay? And this is the reason why. That's why there's bear market rallies. Here's put-call ratio, extremely high. Extreme. Professional traders are very negative, but they're so negative that any little positive news, you have these big bear market rallies, and this is why it's very news sensitive. Okay, you've got to be resilient if you're a trader. If you're an investor, you want to be careful, stay out of the markets in the short term. But certainly, as we get these flushes, you start to come in, and certainly, bear market rallies can be with us for quite some time. But we are in a bear market. On an interesting light, here's World Cup. I'm going to give you a World Cup prediction. I'm picking Brazil to win because I have a lot of friends in Brazil, and I know Brazil extremely well. But if Brazil wins, and here's a very interesting statistic about World Cup victory. So you see Brazil. And every time Brazil wins a World Cup, it's sort of a bull market. So in 1970, Brazil, by the way, while we were going through, and this is really interesting, while we were going through stagflation, the markets in the U.S. markets in the 1970s were a disaster. Yet Brazil had a bull market. Okay, so Brazil won in 1970, started a bull market. Brazil won in 1994. 1994 is when the Brazilian markets opened to foreigners. There was a bull market for 3 years. Pretty good. Another interesting indicator. And then 2002 was around the same time as in the election in Brazil, and Brazil had probably its best bull market ever. It went on from 2002 to 2008, 2009. So if you're bullish on Brazilian stocks, or Brazil does win the World Cup, according to this, you might buy Brazil. EWZ is the ETF, or buy some Brazilian ADRs. But there's your World Cup prediction, and something to think about. But as always, investors, be careful out there.